Welcome back to The Explainer. Today, we're popping the hood on SWX stock. If you've been screening the market for opportunities, there's a very good chance SWX has crossed your radar, flashing some incredibly mixed signals. So, for all you retail investors out there trying to figure out what's really driving its performance, we're going to rely strictly on the data to separate the noise from the reality. All right, let's dive right in. 506.57%. Just let that number sink in for a second. That is SCX's staggering 20-year return. It's the exact kind of long-term wealth generation we all dream of finding. And it's not just ancient history either. That massive long-term number pairs with a totally impressive 31.25% return over just the trailing 12 months. The market has absolutely been rewarding this stock, but we need to figure out exactly why. To keep us from getting lost in the weeds, here is our roadmap for today. We'll start with SWX at a glance, unpack those crucial valuation metrics, dive into margins and profitability, check under the hood for cash flow red flags, and finally deliver a verdict.
Section 1. SWX at a glance. Momentum and dividends.
Starting with the shiny exterior that catches the eye of almost everyone screening for stocks right now, the recent price momentum has been stellar. They've consistently delivered double-digit returns across the board. We're talking a year-to-date return of 17.30%, a trailing 12-month return of 31.25%, and a massive 3-year return of 83.65%. When you see a staircase stepping up this cleanly, honestly, it's hard not to feel a little bit of FOMO. And here's the kicker for the income-focused folks out there. You combine that market-beating momentum with a steady dividend yield of 2.77%, and it's super easy to see why investors are intrigued. Capital appreciation plus a payout that sits above the broader market average, on the surface, it really does look like the total package. Moving on to Section 2, unpacking SWX valuation metrics, a bargain. Let's look at the core valuation metrics to see what we're actually paying for this performance. As a retail investor, the price-to-earnings, or PE ratio, is usually your first stop. Currently, the PE for SWX sits at a very reasonable 15.33. This means it's trading right in line with its 3-year average of 14.66. You aren't paying some massive inflated premium for the current earnings. Compared to a lot of high flyers out there right now, 15.33 feels remarkably grounded. But, as we know, a PE ratio in a vacuum doesn't give us the whole story. To figure out if it's actually a bargain, we absolutely have to look at the PEG ratio. Factoring in the company's growth rate gives us a much clearer picture of value. Generally speaking, a PEG under 1.0 means you're getting a discount on that earnings growth. And while SXX boasts a jaw-droppingly low current PEG of just 0.13, that's essentially the financial equivalent of finding a tailored designer suit at a thrift store. It's heavily discounted even compared to its historical 3-year average of 0.54. From a pure valuation standpoint, a 0.13 PEG is flashing a massive, blinding green buy signal. Theoretically, you're getting explosive growth for pennies on the dollar. Section 3. Margins and profitability. Income surges. Now, earnings growth has to be absolutely exploding to push a PEG ratio down that low, right? Well, looking at the bottom line, it is. Net income has skyrocketed by an incredible 121.22% over the trailing 12 months. And this isn't just some one-off fluke. The 3-year compound annual growth rate for net income is over 60%. The company is pulling in profit at a blistering pace, which perfectly explains that incredibly low valuation we just talked about. Plus, this massive income surge has pushed their net profit margin way up. It's sitting at 7.58% right now, which is literally over 400% higher than its 3-year average. They are retaining vastly more profit from their operations than they have historically. So up to this point, the story is pretty sweet. Cheap valuation, massive profit growth, and expanding margins. But let's not get too comfortable yet. Section 4, cash flow and red flags under the hood. This is where the underlying data presents a fascinating and honestly contradictory mystery. We have to pause and ask ourselves the most important question. If it's this cheap, what is the catch? How can a stock have a PEG of 0.13 while simultaneously printing huge net income? The market is usually pretty efficient, so it has to be seeing a risk that the top-level numbers are hiding. And here is the massive fundamental divergence. Despite that surging net income of over 121%, top-line revenue has actually crashed by over 37% in the trailing 12 months. They're making more profit, but they're generating significantly fewer sales. And even more alarming, actual free cash flow is deeply negative at minus $251.79 million. They are reporting massive accounting profits, but cold hard cash is actively bleeding out of the business. Which brings us right back to that attractive 2.77% dividend we mentioned earlier. On a strictly net income basis, a 41.07% payout ratio looks completely safe. If you're only glancing at earnings per share, it looks like they've got plenty of room to keep paying and even growing this dividend. But here's the reality check. Dividends are paid in cash, not in accounting magic. Because actual free cash flow is deeply negative, that free cash flow payout ratio is entirely maxed out at 100%. The company simply isn't generating the operating cash to sustain these payments over the long haul. If that cash flow doesn't recover soon, that appealing dividend is going to be sitting directly in the crosshairs for a credit. Thankfully, the balance sheet isn't totally on fire right now. The debt-to-equity ratio sits at a manageable 0.89, and the current ratio is at 1.28. This means they actually do have enough current assets to cover their short-term liabilities for now. That balance sheet strength essentially buys them time to figure out their cash flow leak before they hit a true liquidity crisis. Section 5. The Retail Investor Verdict. Weighing the paradox. Let's synthesize all these conflicting signals. As a retail investor, you have a major contradiction to resolve here. You have to juxtapose that incredible 31% market momentum and dirt-cheap valuation directly against the glaring reality of shrinking revenue and a negative $251 million cash burn. Depending on which metrics you prioritize, it is literally a tale of two entirely different companies. Ultimately, based on the raw data, you've got to decide what you believe in more. Do you trust the soaring net income, the expanding margins, and that incredibly cheap PEG ratio that promises massive upside? Or do you fear the evaporating cash flow and the plummeting revenue? Is SWX a rare deep value bargain, or is it just a classic value trap waiting to spring? That's the ultimate question you have to answer before putting your money on the line.